see if they can actually do something with this. Keeps looking like it wants to roll, but it's not rolling.
Some trap shorts, probably.
You know. Not sure if I even trust this. Look at that trap. All right, I think this could be possibly it. We basically missed the daily active level by 1 point. So I'm looking for a pullback to possibly get short. Looking at roughly about 54.50. I'm just gonna wait just a tad bit more. And then I'll take my final stab at a short. It did tap 54.50 though. I feel like it should come back up a little bit. Or not. Son of a bitch. It should still come up to 54.50 again. $54.50 again. Let's see what it does from here. And it might stop. This looks like shit. for break even. I think this needs time. Yep, manipulation right there. Good move to the downside. It's got 30 minutes to enter, whatever you want to enter. After London closes, we shouldn't be in it too much. Look at that manipulation. That's why I got out at break even. It's not worth it.
financial machine learning. So this is pretty cool. We're going to be exploring all the data structures that are within this Advances in Financial Machine Learning by Marcos Lopez de Prado 2018 book, and it's really considered the Bible of machine learning for financial markets. So let's take a look at Marcos de Prado's 4 essential types of financial data. So what he considers to be the 4 columns of financial data is fundamental data, so assets, liabilities, sale, earnings, financial fundamental data, market data, price, yield, implied volatility, volume, dividends, the analytics, which is like credit ratings, earnings expectations, news sentiment, and then alternative data. So Google searches, I've got searchers in there, satellite, CCTV images, and other metadata and things like that. So today we're going to be looking at the 2 bolded information here, price and volume. Now, standard bars for financial machine learning, you would have heard of time bars. Today we're going to look at how to create some of the other ones in Python as well, tick bars, volume bars, and dollar bars. And what we're trying to do is look at how to aggregate tick or trade information actually as information comes in. So as a number of trades come in, as the volume, a certain volume gets traded, and as a certain market value is traded. So let's consider time bars first, and then we're going to look at why you might go and use some other aggregations. So let's first import our dependencies as always. So we're going to import pandas as PD. I'm going to import NumPy as NP. We're going to import matplotlib, plot as PLT, and we're going to import datetime as DT. Cool. So we actually need trade information. Now, this is the actual trade tick information, and usually you'd have to pay for this kind of stuff. So I would really like to get a subscription to one of the brokerage firms that offers trade level information, so then I can go ahead, process that data on this YouTube channel, and then you guys on the channel can benefit from that. So I'm not there at the moment. I haven't been able to pay for a service like that, but my broker, CommSec, does give me access to 1 day's worth of trading information for a particular equity. So in this case, I'm looking at CBA, and we're just going to look at last Friday's information. So I have that in the CSV file that I've pulled down from my brokerage website. All we need to do is we'll call this trades and pandas read underscore CSV, and then we're just going to give it the trade CSV file. Now let's take a look at this pandas data frame. We have time, price, volume, value, market, and condition. Now we're interested in these columns here, and right now we have time on this axis here. Let's get that first into a date time, and then we're going to make that the index. First thing we're going to do is we're going to call that trades.time equal to, and we're going to say PD to date time, and we're going to give it the trades.time. That's just indexing the column and making it the pandas data frame to date time. Now let's make it and actually set it as the index, and what we need to do there is just set underscore index. We're going to give it the time column, and we're going to say in place equals true. What the in place equals true does is it just says get rid of this column once I've made it the index, don't double up. So let's run that. Now we're looking here. Now what we're going to do, let's just make a plot of this, very easy in Jupyter Notebook. So you can just go dot plot, and you can see that we have the volume and value here in green. So yeah, the value is very easy to see. Price times volume, not that hard to understand. But here you can see that we actually have from the time periods from 7 a.m. all the way to 1700, so 5 p.m. And what you'll know is that the market here in Australia, the open hours are actually between 10 a.m. and 1600, 4 p.m. So we've got the pre-market trades here, and we've got the aftermarket, post-market trades and auctions here. So This information is a little bit hard to sift through because sometimes within one tick, one trade information, there's actually many trades that have gone through in the auction. And this kind of information can be hard to identify, and is really going to be an outlier for creating well, a lot of these bars, standard bars that we're going to be talking about today. So instead, what we're going to do is we're going to create a mask and only consider the information during market open hours. So what we're going to do is create a mask. So let's go mask equals, and we will take that trades data frame. We're going to take the index and we're going to slice it. We're going to say that it's going to be greater than a particular time, and that date time, dt.datetime, and we're going to give it the year, the hours, the days. So what are we here? We're the 10th of the 6th, so 2021. The month is the 10th, 6th is the day. The hours that I want from is 10 a.m. and then 0 minutes, 0 seconds. So I'll add another condition now, and what we want to say is that it's going to be less than or equal to the market close, which is 1600. So I've got this thing that is mask now, and what I'm going to say is trades MH, which is just trades market hours, and we're going to use the function ilock to apply that mask. Whoop. So trades market hours, and that's just going to be trades.ilock. So once we've got that, we can take a look at our data frame. And you can see now that the time index there is between our market hours. So I'm just doing this for the stock CBA, so Commonwealth Bank of Australia. So let's start moving into the time bars. How can we actually aggregate on a certain period? So a time-based period, let's say every 5 minutes. Well, this is pretty easy, but we're going to find out why there's some statistical benefits not to do this. So we'll call this time bars. And we're going to say trades market hours dot group by, and we're going to use this thing called grouper, and this takes frequency. So the frequency that we're going to aggregate this data on is 5 minutes. Now, what do we want to aggregate on? Well, we want to aggregate on two different columns. We want it on the price dollars, I'm pretty sure was the column. And what we actually want to call is this function called open, high, low, close. Now, Pandas data frame already has an inbuilt function that's going to return the open, high, low, close over this aggregated data. So that's pretty handy for us. The other bit of information we want is volume, and we want to take the sum of that. So this is just another function that's inherent to Pandas data frame over this aggregation. So we'll be taking those sums. Now, the other thing that we're going to want now is to print that out. So let's say trade bars. Sorry, let's call this time bars. That makes a lot more sense. So now that we've got this time bar 5 minutely aggregation, you can see now that it's kind of dual indexed. So let's actually just let's change this so we only get the close price, open, high, low, close price information. So we'll call this time bars price, and this will be time bars, and we're going to take lock. We're going to take all of the rows, and we're going to only give it that column there. So time bars price, and that should just give us the open, high, low, close information. Excellent. So now to look at the statistical properties of this distribution, we're going to actually calculate the log returns and look at it in terms of a histogram. We're not going to do any statistical tests saying that it is or isn't normally distributed, but it'll be fairly evident from the graph, and we have done that in a previous series on this channel. So if you're interested in looking whether the data log normally is normally distributed, well, you can look back at our channel and find that video. So here are the log returns. Now remember, the log returns are taken with a NumPy function log, and we're just going to take the difference between the trade close price, which is time bars underscore price dot close divided by the same thing but shifted. So time bars underscore price dot close dot shift, and we just shift it by 1. Now, if you press enter on there, you're going to find out that there's one piece of information, and that'll be the start time period, where we don't have this difference. So that's just a degrees of freedom thing, so we can get rid of that by dropping the NA. So this will remove the first time period. So yeah, you can hit go on that and whatever, but let's actually take a look and create this histogram of those log returns. So for that, we'll just go plt.hist. We'll take the log returns, and then we're going to define the bin length. Now for this, I want to use NumPy arrange. So all I need to specify here is I'm going to create an array from the start, finish, and then I'm going to define the step size. Now the step size, I'm just going to call here, I don't know, bin len or something like that, bin len. Let's just give that an arbitrary value of 0.01. We're going to have very small log returns here between time steps, so you'll see why in a second. Let's take the min of log return. Now we're going to take the max of log return plus this bin length, and then we're going to take time, the actual steps of bin length. Cool. And we'll just go plt.show. So as you can see here, this distribution doesn't look normally distributed. Again, could do a Shapiro-Wilk test to define whether this is normally distributed or not. Or KS test or whatever you want to do to determine whether these returns are normally distributed. They don't look normally distributed to me. So you can go and do that as an exercise for yourself. So what are the issues about using time series based information? Well, essentially what we're doing is we're oversampling information during low activity periods where there's low volume, and undersampling information during high activity periods. So this can lead to a number of problems, but often lead to the poor statistical properties that we don't really like. So serial correlation, which is the correlation of the particular data with regards to itself, with a lagged version of itself. So any function, a delayed copy of itself, we've got some kind of correlation, and usually that is not a good thing when we're trying to do all these statistical tests, regression, ordinary least squares that we have in our toolbox to be able to analyze this financial data. Heteroscedasticity, that's often a hard one to pronounce, so I'm glad I've done it there. So this is the variance, and this is the variance changing over time. So the error squared term, whatever data you're working with, financial data, we're calling this variance. Essentially what this means is that we've got a changing variance in our data over time, and this is a problem because, let's say, techniques like ordinary least squares for regression assumes that the residuals are drawn from a population that has a constant variance from an IID process or whatever. So this can lead to some headaches and also non-normality of returns, which of course we are very familiar with in the financial industry. So let's talk about ways that, well, there have been ways to get around, especially the heteroscedasticity. So the Garch models were developed to come up with ways around this when you're using these time bars. However, by sampling price and volume information as a subordinated process of trading activity, so potentially market traded value or number of trades or the volume that has been traded, we can actually avoid this problem altogether. So we're going to look at how to do that now. So for this, what I need to do is create a helper function. Now this helper function is just going to be returning a number of integer bars. So let's call this function bar, and we have x, y. So all we need to return is we're going to return an integer, and we're going to return x divided by y times by y. Now this will become very evident why we're doing this. All we need to define is that for a given data set, we need to define an integer number of bars over that data set. So we've created this helper function here. Tick bars. Now tick bars are the sample variables open, high, low, close, volume, and we're going to sample this over a predefined number of transactions. Now these transactions are going to be, say, 10. So let's say transactions equals 10 or 25 transactions. So 25 trades, and we're going to sample the open, high, low, close, and volumes of the trades market hours data frame over this time. So just like before, we're going to use the group by function. So tick bars equals trades market hours group by, and now we're going to group by. We're going to use this function bars. We're going to group over bars, and we're going to give that the numpy arrange. So we're going to give this an array which is of length trades market hours. So we also need to define in this function how many times, and that is going to be based on the number of transactions. So for every 25 transactions, please divide this data up into however many bars, integer bars, we're going to get back with the length of trades in this data frame. Bit of a handful, but once you actually code this up yourself, you will understand. So now we've grouped by, we need to aggregate on something. So we use that .ag function again, and you guessed it, all we need to do is copy that information that we had up here on price OHLC and volume sum. So let's just copy that information and place it here. So take the price, take the volume, and take the open, high, low, close, calculate the sum of the volume. So once we've done that, we can return tick bars. We're going to do exactly the same thing as we did before, and we're just going to get the price information back. So we're going to say tick bars, and we're going to say lock over all the rows, give me the price information, tick bars price. So that should just give me the open, high, low, close. What have I done there? I've given it the wrong key. Tick bars price. I've put a space there. Sorry about that. So price dollars, excellent. So now all we have to do for those tick bars is actually take the log returns code that we've done up here, and we'll just place tick bars instead of time bars. So tick bars, enter, and we'll need it a little bit more granular than that. So let's go 1 over 10,000. And you can see there that we end up with this a distribution that looks more normal than the actual time bars series. So here I'm not going to prove that. You can use statistical tests, KS test or Shapiro-Wilk test to be able to judge that that's normally distributed yourself. So moving on to the volume bars. Volume bars are sampled every time a predefined amount of the security is actually exchanged in the marketplace. So that's just a given volume. So we'll call a variable traded volume, and we're going to call this like 5,000 units. Could be whatever we want. Now we're going to say that the volume bars is equal to the trades mh dot group by. Now we're going to group over the bar. Now we're going to take numpy cum sum, and we're going to use the trades market hours, and we're going to accumulate over volume. Now to get the number of bars, the appropriate number of bars, we're going to divide through by the traded volume that we're looking at. What properties do we want to get back? Well, we want to get the aggregation of the price space dollars, and we want to use that function OHLC to get the open, high, low, close, and we want the volume, which is just going to be calculated as the sum. But that's almost trivial because we know what the traded volume is going to be. We're defining that 5,000. So let's get the price information, which is just going to be lock over the rows, which is the price. And we just want to show that data frame to make sure that we've done it correctly. So now you can see that we have a traded volume, 5,000. Each 5,000, we have these different properties. So let's check the log returns now of the volume bars and see what that distribution looks like. So just copying the code from above, change to volume bars, and let's look at the distribution. And again, you can see that this is somewhat normally distributed. So we're starting to see that using different ways of getting our standard bars, we can get a distribution that is based on the information arriving or traded value, which actually has better statistical properties, potentially better statistical properties than just using time bars. So let's move on to dollar bars. Dollar bars are formed by sampling and observation every time a predefined value in the market is exchanged. So let's call this market value. And let's say that we're interested, go through the, we're going to make sure that that's equal to trades mh.group by. You'll be very used to this by the end of it. So group by, what do we want to group by? We want to group trades data frame again. We have this value, which is just the volume multiplied by the price, which is the market value that we're interested in. So we're just going to index that column name right there, accumulate on that, and then we're going to create our bars. Oh, sorry, I've forgotten the NumPy cum sum. So we're going to take the cumulative sum of that value, and we're going to create those bars at discretized values of the market sum. So every time this market value is passed, then we're going to create a new bar. So hopefully that makes sense. We're going to take the aggregation again of the statistical low close with volume bars. We want the price information of, take the dollar bars, make sure that returns. We can see that every time $100,000 trades now, we want the open, high, low, close information. So that's really interesting there. Now you could check the lengths of these data frames and kind of compare, you know, the size depending on the market value that is you assign or the volume that you assign to these bar formations, and you can kind of get, well, you can compare this over time and kind of look, oh, how many bars am I creating per day? Does this change with the same value? And that is one of the exercises that's in the book at the end of this chapter. So if you're going to, what we need to do is take the log v, and again you can see that this distribution, run the test that you want, but the open, high, low, close information. So why is it absolutely bogus to hear about people on the internet talking about algorithmic trading, and in fact that they can teach automation? We're talking about things like that gold production is at historic lows because there's no more surface.
That it might go down. So they have a direction in mind. Directional market.
So take a look and I'll be back with you shortly.
I'd like to split up all market participants just in two groups. The first group, and I gave you a couple of examples, but the list is investment banks, any other examples in price, go down participants.
So let's their business model. So they have options, and what I want about their model, well, they based whole fleet of doesn't damage the percentage. This business model means activities where they think these companies need a service
List of market makers and options, internalizers, high frequency traders, brokers, intermediaries, and more examples are possible. What they have in common is that they avoid to be exposed to market fluctuations, price fluctuations. So the first group was direction
strategies. A company is the market maker. Well, you're directionless. You're willing to buy and sell the same product just at two different prices. And that difference between the buy and the sell that they're willing to offer and bid on the same product is called the bid-ask spread. Now, this is what incentivizes a market maker to actually create a market, to provide that market liquidity to people like us, retail investors, and other institutions out there. But this is their incentive. That is their edge, and they are wanting to actually capitalize on that difference that way. Now, there is significant risk with that. So that